Welcome to Market Catalyst. I'm Julie Hyman. We have 30 minutes into the U.S. trading day. Here's what we're watching this hour. First up, Nvidia, $5 trillion valuation. We'll have more on Nvidia and on the tech trade ahead of Mag 7 names reporting after the bell. Plus, we'll have more earnings coverage on companies ranging from Boeing to CVS. And we'll speak with the CEO of Securitize as the tokenization firm prepares to go public via SPAC. Let's take a look at the major averages here this morning. We do see a continued push to new record highs as we have been seeing as of late. Right now, the Dow is up nearly 280 points here, about a little more than 0.5%. The S&P 500 is up 0.4%. The Nasdaq is leading gains, not surprisingly, up 0.75% with its Nvidia participation. But remember, Nvidia, it's in the S&P and the Dow too. So all of them get the benefit of that new record, both price and valuation for Nvidia. So here it is, above $5 trillion for that market cap for Nvidia. Just yesterday, we were talking about Microsoft and Apple being above $4 trillion, and Nvidia says, hold my beer, and here we are at $5 trillion for that stock. Take a look at the price action here today. That was the market cap. Whoops, here's, I'll get there eventually, folks. Take a look at the price action. Nvidia shares are up 5.4% today. A couple of things that are contributing to this latest push higher. First of all, we had CEO Jensen Huang speaking yesterday at the company's first ever GTC conference in Washington, D.C., where they really emphasized the partnership between the administration and the role that sovereign AI plays in the push for data center expansion and the AI wave. And Huang also sort of intimated that data center revenue next year will be even higher than analysts had anticipated. That seems to be the chatter among analysts who follow the stock this morning. If we look at semiconductors more broadly here, beyond just Nvidia, we see a pretty big push higher. We also, by the way, had memory chip maker SK Hynix out of South Korea out with its numbers that topped estimates. So we're not just seeing Nvidia higher. Broadcom, TSM is higher, AMD, ASML, a few outliers here that are not higher, including Intel and Texas Instruments. But broadly, we are seeing this Nvidia effect lift the rest of semiconductors. And then if you take it on over to the sectors, you see it being felt there as well. The XLK, which includes Nvidia and is tech, is leading gains today by a pretty wide margin. It's also worth noting, by the way, we keep talking about narrow leadership. The S&P 500 is up today because of tech, right? Because you have a lot of lagging groups here that continue to be some of the interest rate sensitive groups like XLRE, the real estate group. You got financials lower, you got consumer staples. So it's really tech that is holding things up today. And we're, of course, watching a lot of earnings related news as well. We continue to watch that. Equal weighting here and taking a look at the Dow in the lagging position today. We got Caterpillar up, yes, as well. We should mention that. Those earnings, Nvidia up, but we've got Boeing down about 2.6%. So that's something to keep in mind. It's still earnings season. We still have a lot of other big companies that are out with their numbers. I want to zoom in on Boeing now because it did top third quarter revenue and free cash flow estimates, but that's being overshadowed by a nearly $5 billion hit due to additional delays for its long-awaited 777X jets. Joining me now, Tony Bancroft, Gabelli Funds portfolio manager. There are a few people who know this industry as well as you, Tony, so I'm really glad to have you here to talk to us about this. You estimated a write-down from the 777s, but it wasn't a nearly $5 billion write-down. How surprised were you by that number?
You know, I think we knew it was going to be significant. Maybe it was a little more than expected, but let's take the big picture here. The 777X program has about a 600 plane backlog. At rate of production, that would be about 4 or 5 months of deliveries for that aircraft. So delaying it by 4 to 5 months on a $500 billion backlog of commercial planes, that's over a decade. 6,500 planes in backlog, which essentially went up during the worst commercial travel crisis in history. I think it's a forest for the trees scenario here. I think the big picture is Boeing's doing well. All their segments were incrementally improving on top and bottom line. Free cash flow is positive, and the outlook is looking pretty strong for Boeing.
And when you take out, when you set aside that write-down, as you said, in that positive free cash flow, which the consensus was for continued negative free cash flow, how did they achieve that? How did they get there? and how much of that is because of Ortberg's leadership here? He's a little more than a year into his tenure at the company. How much of that is due to changes he's making?
Yeah, I think it's blocking and tackling. He's doing all the right things and things that need to be done. Working with the FAA, getting a safe, efficient production line that's functional and putting out good jets that have good feedback. And he's just doing what essentially needs to be done and focusing his attention, sort of the 80-20 principle on what matters. So I think he's done a great job there. He probably can continue to keep doing a great job. And, in the long term, the outlook is very positive for Boeing. That's why we like it in our Gabelli Commercial Aerospace and Defense ETF, ticker GCAD. It's one of our larger holdings, and we're pretty positive.
I've also seen some headlines that as part of the, it looks like preliminary trade agreement between the U.S. and South Korea, that Korean Air is going to be buying some new Boeing aircraft as well. So when you think about the commercial business versus the defense business at Boeing, where do you think is the area of most potential growth going forward?
I think the biggest piece of Boeing, of course, is going to be the commercial business. But they're one of the largest defense contractors. They're a top inside of top 10, top 5 defense contractors in the world. So their defense business is strong. They've won some recent contracts, some large recent contracts, and they've had some big orders just recently. So I think that's going to do very well. Get back the profitability that they historically were in, and I think both businesses are pretty good.
For the 777X, is this the end of rate downs for that plane? I mean, now they're saying they're targeting 2027. Is that realistic at this point, and what's the outlook for that?
Yeah, the 777X the planes has had obviously some issues. But the demand is there. They're going to get it to work. The G9X engine, it works. And there's some obviously new technology on that plane that sort of needs to be worked out. And I think eventually they're going to, this is Boeing. Every other second a Boeing airplane takes off from Earth. So I think Boeing will do a very good job of figuring this out.
I love that stat, Tony. Every other second, a Boeing plane takes off from Earth. I do want to broaden it out a little bit because, as you know, this has been a really good year for defense and aerospace stocks broadly. I'm wondering how much more runway, forgive the pun, you think that these companies have from here, given that some of the tailwinds have been policy or defense spending, but also that commercial demand. How sustainable is all of that?
Well, I sort of on both sides. On the commercial side, commercial travel continues to be strong. We're seeing record levels. People want to travel more. So I think, the runway remains there. And on the defense side, I don't think, again, the world's getting any safer. We're seeing, Ukraine really, not much has changed in Ukraine as far as the progress of the war, coming to a peace agreement. And essentially same, there's fits and starts in the Middle East that's still an issue. And then the bigger picture, long term, sort of the pivot to the Pacific and the China North Korea threat. You saw the commander in chief go through and do the Asian tour this past week and talking about need for increased defense spending amongst Asian countries and major NATO non-member allies. And those numbers are large numbers if they're talking that 2% for certain countries, 3.5% to 5%. Those get pretty big. So I think we still have quite a big runway to go.
And Tony, we're showing some of the defense stocks there. We talked about Boeing already, which I know you like. Do you have another one that is like your favorite within the sector?
Yeah, I do. A company called Hexcel, ticker HXL. It's a small, relatively small company, but they've got high technology in doing carbon fiber composites and resins. They're the ones that essentially build the fuselages, the shells for these large, particularly wide body aircraft, the A350 and the 787. But as well, they make parts for defense industry for aircraft. Carbon's faster, stronger, lighter. It's just a better material to build aircraft. And as we see more technological improvements and need for lighter weight, more fuel efficiency, all these things, everything from aviation to space, you're gonna see more carbon fiber. So they have structural, secular tailwinds behind them, and as scale comes on, obviously operating leverage is going to improve as well.
Cool, Tony. Good to see you. Thanks so much.
Thanks.
CVS Health reported record revenue for the third quarter and raised its full-year earnings outlook. It did report one-time $5.7 billion charges related to its healthcare delivery reporting unit and its chain of primary care providers. Health insurers have lagged in 2024. CVS Health did recover in 2025. It is up over 80% year to date. Megan Fitzgerald is joining us, Gragos Capital private equity investor and Tenet Healthcare board member, longtime close watcher of the healthcare industry. Meg, it's good to see you. So what do you make of these CVS results? And does it sort of solidify that the turnaround under David Joyner is well on track?
Yeah, great to see you, Julie. I think, as you kind of said leading into this, managed care, I think in the last 15 years, this might be the worst period for them. They normally trade at a discount of 10% to the S&P. They're trading at a 45% discount. So heading into this earnings, there was a lot of discussion about the sector. And I think CVS absolutely delivered. I think they beat and raised at a time where people were very worried about the healthcare benefits segment. So David Joyner definitely had a great first year. I think the notable exception is the write-down that they had to take in Oak Street. And I think they've laid out a plan to kind of stall the growth on that and make sure they get back to business, which is really serving patients as a retailer and a pharmacy.
Why do you think that Oak Street is having that trouble? So it's primary care clinics for seniors. Why is that business challenged, and how do they fix it?
Yeah, I think it's really difficult. Most people that are addressing primary care are finding patients to be a lot more sicker, and the reimbursement rates they're getting for those patients have really been constrained. So I think when you look at CVS's footprint, 85% of Americans live within 10 miles of a CVS. So they're used to going there for pharmacy, not necessarily for primary care. So I think it was a bit of a diversion for CVS to do this. Understand why. They're a diversified company. They have a PBM, they have insurance, they have retail. So adding primary care, I think at the time strategically made a lot of sense, but that hasn't really played out that way.
And in terms of the insurance business, you mentioned the so-called medical loss ratio, how much of those premiums they pay out to cover costs. For CVS this quarter was 92.8%, which I think was better than estimated. Still, it's higher than United Health, which just reported and had under 90%. Overall, we've been seeing those MLRs like pretty sticky, even if they've been improving a little bit. So is that a bigger industry issue, and what do they do to address that?
I think this was good for CVS. I think this was better than we thought, or right on by a few basis points. So I think CVS is going to continue to work on this. As you know, you keep more of the dollars, the lower that number is, and you do better by having high star numbers. So they've been heading in the right direction on their stars, and I think heading in the right direction on the MBR. So I think the street and all of us watching this were happy with this number, but I bet CVS, as they close out the year, will want to, work to improve this, because that drops right to the bottom line.
And Meg, I wanted to broaden it out a little bit. Interestingly, CVS had already previously said it was getting out of the ACA business, the Affordable Care Act business, next year. But as we know, that business is very much in focus right now because of the expiration of the additional federal subsidies and coverage under that program. So what do you think the implications for the industry are? And I guess I should start by asking, do you think Congress will get itself together and extend that program?
They have to do something, but shopping starts now for consumers. So you're shopping blindly. It might as well be called a secret shopper. You're going to get a price, and if Congress does advance some relief, you're going to get a different price. But the window to shop goes from now until about January 15th. So this is a huge uncertainty hanging over the entire industry, but mostly for consumers. 40 million consumers are affected, and for some of them, the premiums have doubled. So I think this is an overhang overhang for the whole industry, waiting to see what Congress will do. I think they have to do something. This is not favorable to either side to have this many consumers in limbo. I think both sides will take a charge for this politically.
And do you think, Meg, that there are going to be a number of people who are shopping right now who just are throwing their hands up and saying, I'm just going to risk going without insurance for right now? And are those people going to be younger people? And does that then, create some more cost pressures within the system?
You nailed it. The young invincible, when they see a double, they will opt out. And so what's left for underwriters is a book of those that might be more expensive, have more chronic disease, and are sicker, and therefore would be more expensive. So I think what you said is exactly what the risk is right now, that those that don't need insurance will either take a catastrophic plan or simply sit it out.
Now, once people have locked it in, that's for the next year, right? So they're having to make these decisions now, as you said, flying blind, and then they can't make that decision again until the next period, right?
Right now, that's the way it's written. I think some people have till the 15th of January, unless they're going to make some type of an exception. You've got a month to play whack-a-mole and figure out what program you're going to get and quickly shop around on something that is already really difficult to buy. It's probably the most difficult purchasing decision somebody will make. And to think that you're going to get two different prices and then possibly have a change, it's a pretty arduous process.
Yeah.
Should be a lot easier, really not fair to the consumer. And this is something that should be addressed right away.
Yeah, no fun. Meg Fitzgerald, great to see you. Thank you so much.
You too.
All your markets action coming up. Stay tuned. You're watching Market Catalysts. Tokenization platform Securitize is the first company of its kind to go public via a SPAC deal with Cantor Fitzgerald Equity Partners II in a deal worth $1.25 billion. So let's talk more about tokenization and what value it provides to companies and their investors. Carlos Domingo, Securitize founder and CEO, is joining me here in the studio. Carlos, thanks for being here.
Thanks for having me.
So we've talked for a while. So congrats, first of all, on this deal to go public. And Securitize and tokenization has really become a buzzword since we started talking, I think, a couple of years ago. It's really gained a lot of speed. Yeah, exactly. So I want to talk a little bit about the sort of concept of tokenization first and the value that it brings. We are seeing more of an interest in tokenizing a broader swath of assets, right? And I think most interestingly, or most recently, stocks being tokenized is something that has come into the conversation. Why would I want to, and how does it work? Why would I want to tokenize a stock?
So look, just to explain what tokenization is in layman terms.
Yes.
Every transaction in capital markets, whether it's a stock, a bond, a fund, a redemption, an interest paid, whatever, dividend, involves updating a ledger. Right? So somebody has to have a record of who owns what and how that transaction affects the ownership change and also the money that you've used to pay for the transaction. So tokenization is nothing else but taking these securities and that are in antiquated ledger technologies, silo, not connected to each other, and put them on a modern public distributed ledger technology like a blockchain is to provide all these efficiencies. So why people want this? Well, it's going to democratize access to a lot of assets. It's going to make the assets easier to move around. It's going to make them easier to borrow against them. It's going to make it easier to receive dividends on time, etc. So ultimately, this becomes like a better way of holding and trading the assets.
I guess what I'm confused about is why create a token twin of the asset rather than just securitizing the asset itself?
That's a very good question. So what we do is we actually work with the issuers. So when we issue a token, the token actually represents the security. There is no other copy of that security anywhere else. It's not a twin. It's the actual native representation. It's represented on a different ledger, a blockchain, with the entry on that ledger is called a token. So this is not a twin. This is a native representation.
Well, but for example, if it's a stock, it's not the stock. You're not owning the stock itself. Are you? Okay.
Yeah, of course. So actually, most people don't realize that when you, let's say, buy stocks on Robinhood, they're not under your name on the cap table. They're actually under the Central Securities Depository, the clearinghouse. DTC has a company called CD & Co. that all the stocks are actually under their name. But you can actually request those stocks to be placed under your name through an entity called a transfer agent, which every publicly traded company has. And then when you do that, if the transfer agent uses a blockchain as their ledger, then that's tokenization, and you're going to get a token. So it's actually a better mechanism. You're actually really owning the stock. You really have rights. You can vote directly. You can receive the dividends immediately because they will know that you are a beneficial owner, etc., as opposed to holding the stocks in the traditional way.
Okay, so we've gotten a little weedy here, a little bit in the weeds. But ultimately, do you expect that the whole U.S. stock market will be tokenized? And will that, in effect, replace the ledger system at some point?
So look, new technologies don't necessarily completely displace all technologies, right? Like, today everybody uses, cloud and PCs and phones, etc. But some banks still have the mainframes where they run their old systems, right? And they've never got rid of them. So I do believe that, the existing financial services industry, as we know it, it will not be completely displaced, maybe over time, but a very, very, very long period of time. But a new, market that is based on blockchain rails, that is more efficient, is faster, is cheaper, is easier to access, will emerge in parallel, and eventually, over time, will be migrated over there.
What is the feedback loop from tokenization to the underlying asset? In other words, is there a risk that disruptions in that market or moves in that market will create a feedback loop to the original asset?
It does not, right? So the tokenization is simply that the token represents the ownership on the asset. So whether the asset changes or not in price, it will happen irrespective of whether you have a token or you have another mechanism, right? So, of course, today markets, they actually, have certain regulations around guaranteeing certain price for transactions and stuff like that. So when you create markets on chain, you need to figure out how that you're going to provide the same guarantees. But besides that, the token itself is not going to be disrupting anything as far as it continues trading according to existing regulations.
Where have you seen the biggest demand for all of this?
I mean, look, with one idea is that, here in the US, we're very spoiled because we think that, it's very easy to access stocks, and everybody has brokerage accounts, and we have companies like Robinhood and others that have really democratized access to this. But as a European, in Europe, the same thing doesn't happen. People don't have access to brokerage accounts. They don't necessarily, transact on stocks frequently like people do here, etc. But they do it with crypto. So there's an argument. Sorry, I've been talking a lot the last 2 days.
Yeah.
There's an argument that you can, give access to non-US people in a more efficient way through tokenization than today with normal markets.
Interesting. Okay, so there is that potential for it to be more of a use case elsewhere.
Sorry.
When do you expect the SPAC combination to be complete? And I'm curious why you decided to go SPAC versus a traditional IPO process, for example.
Look, that's a good question. So we look at both options. In our case, we thought that an SPAC done the right way is a very good mechanism for a company of our size. And it also kind of like de-risks the process and the outcome. We've already done it. We already announced the valuation. We already raised the pipe. So that's all done. And now we need to do the regulatory filing, as opposed to a traditional IPO that we'll have to do the regulatory work ahead and then go to the market maybe in Q1, Q2 next year. So with this process, we're done. We already have our partner. We already have the money in the bank. We already have the valuation set. And then, as soon as the government opens and we can actually file with the SEC a document called the S4, which is the merge agreement between the two companies, then, they'll take 2 or 3 months to review it, hopefully, and then we'll go, we'll become publicly traded and replace the ticker of the SPAC with our ticker.
Okay, thanks so much for coming in. Appreciate it.
Thanks for having me.
Good to see you. All right, coming up, some of this morning's top trending ticker. Stay tuned. You're watching Market Catalyst.
Welcome back to Yahoo Finance. I'm Brooke Tabama, live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. We're watching shares of Nvidia, Apple, and Victoria's Secret. First up, Nvidia, both UBS and Melius raised their price target on the stock after the company indicated that it was seeing orders for Blackwell and early Rubin chips that were above $500 billion through the end of next year. The UBS analyst said the new commentary suggests street estimates are too low by a significant margin. The average price target is now at 225, and UBS's price target's now 235, while Melius, well, it's 300. That company cost the $5 trillion valuation this morning. Next up, Apple. Bank of America raised its price target on the stock to $320. That's now the highest price target on the street. The average price target is around $253. In a note to clients, the analyst laid out a 5-year outlook for Apple's revenue, operating margin, and earnings growth. The analyst wrote that it considered new products and services that could be introduced over the next 5 years, plus the impact of artificial intelligence on Apple's revenue, those new product offerings, and how it could be disruptive in other ways. And last up, Victoria's Secret. UBS upgraded its rating on the stock to buy from neutral, citing 3 key reasons: increased conviction on management's ability to reposition the Victoria's Secret brand and the Pink brand, as well as meaningful upside to the street's forecast, and lastly, a powerful earnings per share growth algorithm. That stock, though, is still down about 10% year to date. Keep it right here on Yahoo Finance. We'll be tracking all the market moves and top calls throughout the session.
Now time for some of today's trending tickers. We are watching Etsy, Kraft Heinz, and Teradyne. First up, Etsy, the online marketplace announcing a C-suite shuffle. Chief Growth Officer Kruti Patel Goyal will replace Josh Silverman as CEO. Silverman's been in that role for 8 years. Goyal will take over the e-commerce business that has suffered slowing growth in recent years. Revenue projected to rise just 1% in 2025, a sharp deceleration from a pandemic-fueled sales boom. Next up, Kraft Heinz, the consumer giant lowering its sales outlook, citing slower growth in emerging markets and pressure in U.S. retail. The company's CEO said he's seeing the worst consumer sentiment in decades. He said that higher prices from inflation and expected headwinds from curtailed food stamp funding were creating a tough environment. Kraft Heinz is still expected to split its business into 2 publicly traded companies. That's likely to be completed in the second half of next year. And finally, Teradyne. It's the maker of test systems for semiconductors and robotics. It beat quarterly earnings expectations. The company also issued a strong outlook. Teradyne expects revenue between $920 million and $1 billion for the current quarter. That's well above the $816 million that analysts had forecast. Investors can thank it artificial intelligence. No surprise. The third quarter growth came primarily from system-on-a-chip solutions for AI applications and strong results in memory. Those shares up 15%. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, the Royal Caribbean CFO discusses consumer demand, the company's expansion plans, and more on Market Catalyst. Cruise line Royal Caribbean Group topping Wall Street's profit estimates and hiking its guidance as demand remains strong. Still, the stock is lower as revenue came in just shy of estimates, and investors wanted a little more from that guidance. Joining me now on this, Naftali Holtz, Royal Caribbean Group CFO. Good to see you, Naftali. So, as we have seen in the stock, and as I've seen from analyst commentary, they were hoping for a little more, not just from the guidance for the rest of this year, but also going into next year. So what can you tell us about that guidance, and what are some of the factors affecting it?
Well, Julie, great to be with you here again, and we're very excited about what we're seeing in our business. We're going to grow the business this year. We're going to grow earnings by over 30% on a very strong demand. And we're seeing a lot of great bookings in every day that that guests are on our ships, or when we look at the booking environment, and we're seeing a lot of excitement from our guests to come on vacation, to continue to prioritize that. And we're seeing that for the rest of the year and into next year. And as important for us is not just only what we'll do next year and next quarter, but how we are going to take this amazing opportunity to win more share of a massive and growing $2 trillion vacation market. And we believe that our strategies, our investments, our brands, our ships, our destinations, and the experiences we deliver are position us exceptionally well to grow, not just this quarter and next year, but over the next decade.
I know one of the things that analysts were focused on as well was the yields on the ships, how much people are spending, how much, and also how much revenue you get per customer. I believe CEO Jason Liberty talked a little bit on the call about maybe some increased price sensitivity among your customers. Can you talk to me about that, or how much pricing power you expect to have next year on ship?
Yeah, so first, I think it's very important to note that we continue to see a very engaged consumer. And if you look at the alternatives that vacation for the consumer, cruising and our brands are a very, very attractive value proposition, both on the quality of the experience and the price. And what we also said on the call is that as we look at the booked position for us and kind of the bookings, we are booked at a higher pricing for next year growth compared to for last year, and actually on the higher end if you kind of look at a historical average. So we feel very good about making sure that we get the customers to really value our vacations and kind of going into next year. And our focus is really making sure that we give them the experiences they want. That means the ships that they want and really innovating around that, having very attractive itineraries across the world, making sure that when they get on the ships, they have the right experiences and attractive experiences to choose from, shore excursions, restaurants, entertainment, and we see that definitely in our booking environment as well.
So they're booking, but I guess the question is, will they be spending, and will the spending go up at the same cadence that you've been seeing, or is that moderating to some degree?
Yeah, so we're seeing them continue to spend more and higher price per dose on the ships. We do subscribe to the formula, which is moderate yield growth. So obviously in the last couple of years, we were catching up and there was extraordinary yield growth, double-digit yield growth in the last couple of years. But this year, it's more of what I would call a moderate year for us that we basically think about as we run the business. And we said today that we're going to grow our yields 3.5% to 4%. And as we go forward, that is the kind of the moderate yield growth that we're looking for in our business.
Naftali, a couple of things you guys are working on. You're working on more land-based destinations that your ships go to, including a new beach club in Santorini. And you're also pushing in further into the river cruising business. How much growth do you think those two areas are gonna yield for Royal Caribbean?
There are very exciting aspects of and additions to our ecosystem. And really our goal is to make sure that we design the vacations and have that ecosystem that with experiences that the consumer want, and we then compete with other land-based vacations. And so our destination portfolio is very, very exciting. Today we have 2, and we will grow it to 8. So from 2 to 8 by 2028. That is a lot of great, exciting things that we will have, all the way from our Perfect Day Mexico to Paradise Nassau this year, to the Santorini Beach Club that we announced today that will open next year as well. And those are great experiences that not only that they get high satisfaction scores from our guests, they're very accretive to our financial results. River has been a very excited experience for us and that we added just a couple of months ago. The response from our customer has been just extraordinary. The initial inventory on those river products that we offered sold out within minutes. And what was really exciting is that majority of the guests that booked were actually celebrity and Royal Caribbean Group guests that have never experienced river cruising before. And they're very excited to get to another occasion with us. And so for us, this is a great opportunity to continue to expand our vacations and offer more to our customers to vacation with us as they seek to kind of explore the world.
And Naftali, finally, I want to ask about Hurricane Melissa, which of course is bearing down on the Caribbean as we speak. I'm just curious what kinds of cancellations or reroutings you're having to do to deal with the storm.
Yeah, so first, I think the most important thing is that our thoughts are with those impacted, especially Jamaica, and we're monitoring that very closely. We obviously have employees around those regions as well, so for their families, and we're here for them and for those communities. It's very important to us. We're monitoring those. We made some minor modifications. We don't actually have planned sailings in the next week or so anyways there. But we are monitoring the situation. We make accommodations and adjustments as needed.
All right. Thank you so much for your time, Naftali. Appreciate it. CFO of Royal Caribbean. Thank you. Regulatory changes could be coming to ETFs and mutual funds that could mean cost savings for investors. Here with me to explain, Valerie Grimba, RBC Capital Markets Director of Global ETF Strategy for this week's ETF report. Thanks for being here.
Thank you so much for having me, Julie.
So obviously we've seen a huge growth in ETFs. Mutual funds still dominate, but ETFs have definitely grown a lot. But they exist as two sort of separate but parallel entities, which I didn't entirely realize. In other words, a mutual fund and an ETF can't be like two shares of the same core thing, right? So how does it work now?
Yes, so right now ETFs and mutual funds are very separate structures, but what we are going to see probably likely come to market is a dual share class. So that means that there's a pooling of assets, and that should allow for an investor to move seamlessly from a mutual fund to an ETF with kind of no tax consequences. And so this is something that Vanguard has had a patent on, and so they've been the only exclusive users of this dual share class on their passive index mutual funds and ETFs. That patent expired 2 years ago, and now it's been this long waiting game of a bunch of other asset managers filing with the SEC for exemption and the ability to also create a dual share class.
So why do we think that we're getting closer to it actually happening?
Yeah, so at the end of September, the SEC gave notice, and that's kind of them preempting the fact that they've said dimensional fund advisors, we're taking a look at your application, we're going to review it, and then that triggers a 14, 15-day period before we are supposed to receive kind of approval from SEC.
Okay, so the government shutdown's happening. Does that mean it might be more like a 30-day period or whatever it might be because of that?
It's been a bit of a moving target right now, but the reality is that that window has since passed, and we think it could really be imminent at any day now.
And when that happens, what does that mean for investors, right? You know, as I said, we've already seen the migration, a big migration to ETFs. Does it sort of cement that if it's easier to make that migration?
Absolutely, and we think it's actually, if anything, going to really accelerate the movement into ETFs. I mean, it's not hard to imagine a world where the number of ETFs in the US doubles and that the ETF AUM also doubles alongside of that. So right now there's over 4,000 ETFs. That number could be 8,000, 10,000.
Wow.
And so we really expect this to really kickstart even more growth.
Now, remind people who are watching, if I'm trying to choose between a mutual fund and an ETF, what the advantages are for each.
There's a lot that we know and love and we talk about in the ETF space. Of course, they're typically lower cost. They're lower cost even for the asset managers to operate. There are some efficiencies there, and typically those can be passed on to the end investor. There's, of course, the intraday liquidity, allowing an investor to buy and sell right during market hours. There's transparency, so the investor understands and knows exactly what the ETF is holding. And then, of course, the big piece here is the tax efficiency of an ETF. Because market makers can interact and we're out there and we can create and redeem ETFs in kind, this mechanism provides a bit of a tax efficiency. We don't have to crystallize capital gains immediately. And so this makes ETF a preferred vehicle for most investors now.
Is there any reason to have a mutual fund? I know you're on the ETF side, so like you're talking your book, I get it. But is there any advantage?
And I think that's why we've seen this really shift in fund flows, in that the mutual fund industry has really been shrinking. It's been seeing outflows, and the ETF industry has been seeing net inflows. You know, this is a 20-25% CAGR for the last 10 years. $1 trillion of inflows last year. We're on pace to be 1.25 this year. It's really just the movement is towards ETFs, and I think it's to all of those key points we just talked to.
Right. Compound annual growth rate, by the way, for CAGR is what we're talking about there. And you know, there have been some folks who have looked at the explosion in the ETF industry, and they've said, well, does this create some artificial support in the market, for example, that huge passive wave that we have seen?
Yes.
How do you think about that, especially if we're going to go from 4,000 to 8,000?
Yes, I think actually the reverse is true. Actually, ETFs have solved for a bit of a release valve in times of market duress or times of stress. Like we saw during Liberation Day, SPY and the ETF industry at large could absorb kind of this market stress, and then therefore it was kind of the release to let everything simmer. And then also I think it's just it's becoming more active too. We're seeing a lot of diversification in the strategies that are coming to market, a lot more sophistication, and really the big word actually is democratization of previously unaccessible investment strategies being wrapped up into an ETF as a convenient solution for the end investor.
And finally, I'm curious, once this rule change happens,
yes,
how quickly is the industry poised to make the change?
Yeah, it's a great question. And definitely the industry has been getting ready for the last 2 years since the patent expired. But there is going to be a little bit of operational readiness. But we do think, 1 to 2 years, this is really going to be a game changer. And if we look back on it now, I think it's going to be the velocity at which things are going to change is going to be high.
Wow. All right. Looking forward to tracking all of that. Thanks so much for coming in. Appreciate it. Coming up, we got full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. "90 minutes into the start of U.S. trading. I'm Julie Hyman. Let's get a check at the markets here. We are seeing the major averages push to new records here. The Dow doing the best of the actually tied with the NASDAQ, let's call it, helped in part by earnings from Caterpillar as well as Nvidia crossing over into a record and a $5 trillion valuation. The Dow right now up more than 250 points, the S&P up 0.25%, and the NASDAQ up about 0.5%. And indeed, Nvidia, officially the first company to hit a $5 trillion market cap. The rally in shares after a slate of reveals at its GTC event and on optimism for its Blackwell sales to China, or potential sales. For more, let's bring in Doug Clinton, Intelligent Alpha founder and CEO. Doug, it's great to see you as always. What do you make of this latest leg up in Nvidia at a time where there are all these questions about an AI bubble? And here comes Nvidia let's take another leg up here.
That's usually how it happens, Julie, as funny as that is to say. When everybody starts talking about, hey, are we in a bubble? I think counterintuitively, markets usually do the things that people don't expect, and that is they just keep going up, and Nvidia is leading the charge. I think that what we're seeing with Nvidia is the reality that none of the hyperscalers are going to stop spending on CapEx, building out the AI infrastructure that we've seen over the past year plus now. And I think that that's just being factored into Nvidia. The reality is that numbers will probably continue to go up from Nvidia. There's this catalyst maybe with China. Maybe China gets opened up for Blackwell, and that could be additional upside, but it just feels like all things are kind of going right for Nvidia right now and the AI trade more broadly.
I mean, the Blackwell question is indeed a maybe right now. We don't know if China and the U.S. are going to come to an agreement on that. So how pivotal is Nvidia? How pivotal is that for Nvidia? I mean, the shares had already been pushing up towards a record even without that news.
I think that it's probably not fully priced in. I mean, if I had to put odds on Blackwell, just the full out, the GB200, I think President Trump called it the super duper chip, kind of the high end chip. I think it's probably 10 to 20% that gets fully opened up at this point. And so if we did see that happen, I would imagine that Nvidia stock would probably go even higher. In the nearer term, though, this week, we will have earnings from several of the hyperscalers. And I think we're going to hear continued commentary around them not slowing down in terms of their infrastructure builds. And maybe that's sort of what the market is pricing in now, just getting a little bit ahead of that positive commentary.
Do you think that there will be any acceleration in spend from here? Or do you think it's more of, I mean, they're already huge numbers, to be fair. But do you think that it's a matter of maintaining that pace of spending?
I think some of the numbers are actually probably too low. If you look at the street CapEx numbers for Google and Amazon in particular, the street's at 12 and 9% for next year. And to put that into context, Meta, the street's expecting about 40%. So I think something has to give, and my gut is we'll probably see Google and Amazon talking about continuing to spend more. And I think those street numbers have to come up. It may not necessarily represent an acceleration, but I think it will represent a pretty strong continuation of what they've been doing.
Doug, what's also intriguing is the raft of partnerships that Nvidia announced during that Washington, D.C. GPT. I mean, everything from Uber to Lucid, we've got a list of some of them up on the screen here. Nokia, that was an interesting and surprising one. So there's the ecosystem continues to grow, right? Originally, we talked a lot about the circular economy with OpenAI at the center of that. And now you have all these other companies that aren't squarely in the AI business that are doing all of this. Does that mean that the potential for growth is expanding, or is it also that the potential for risk is expanding?
I think it's probably, Julie, an embrace of what these sorts of announcements, a partnership, does for stock prices. I mean, I think management teams are acutely aware of the reality that if you announce a deal with Nvidia or OpenAI, you're probably going to have a pretty good day on the stock market.
Okay, so Doug, so that's a little bit of a cynical view, a realistic view, but like, so how real then is it? Like, you know, you've seen, it's not just Nvidia, like people are saying, oh, you throw ChatGPT in an announcement and the stock goes up, but is it actually going to yield more profits for shareholders at the end of the day?
That's the perfect point, because that's actually all that matters at the end of the day. The way that we have thought about this whole circular economy question is, yes, there are a lot of partnerships. Everybody feels like they are entangled. But the only thing that matters at the end of the day, when we kind of look out 3, 5, 7 years from now, is does this technology create incremental cash flows that justify all of this spending? It's not going to do it this year. It's not going to do it next year. And no one should expect that. But I think when we think about that longer term picture, 5 and 7 years, ultimately that will be the determinant about whether these are good partnerships, whether these are good deals or not. I think that when we see ones with, you know, an Uber, for example, Nvidia maybe is a little bit outside of that. But the question is just, you know, what are we really going to see from a deal perspective? What can that really add to Uber's core business? And maybe there's something there that we're not aware of yet, but those feel like they're a little bit more on the very heavy optionality side versus the potential to add incremental value to the AI trade.
Gotcha. So that's a little bit more of a wait and see perhaps on that front. Another partnership that I want to ask you about that was solidified even more this week was between Microsoft and OpenAI, with OpenAI completing its recapitalization, restructuring, and them effectively being almost equal partners in the new structure. Does that mean for you, is Microsoft even more of a buy than ever because of that exposure and that sort of codified exposure?
Well, I'll tell you, Julie, at Intelligent Alpha, we use large language models. We're big believers in AI, right, and we use those models to do our stock analysis and portfolio management. Microsoft is a stock that our models like and we own. And so I think the reality is Microsoft continues to be probably the best direct exposure to OpenAI, which is obviously the best positioned, I think, AI company in the world right now. I think that this partnership and this announcement, it's actually sort of a win-win for both sides in a sense, where I think it unlocks OpenAI to kind of continue to raise additional capital. They're going to bring on other capital partners in the future because they have huge capital needs. And I think for Microsoft, obviously, you know, they have a, as you mentioned, very large stake in what I think will probably ultimately be, you know, another multi-trillion-dollar company in the next few years.
And of course, that multi-trillion-dollar company is coming public in the next few years also. You know, it's too early for you to buy it as a public company, for any of us to buy it as a public company. But, you know, what do you think that effect will be in the market? Like, does it sort of suck all the air out of the room from everything else when that finally comes public?
It'll definitely be a watershed moment, I think. And, you know, in my view, I've always thought about boom cycles in a very simplistic way, which is when the IPO window really opens up, I think that's when you have to be thinking a little bit more conservatively, where that could be getting more toward the end. Now, OpenAI, they haven't gone public. And when they go public, I don't think that is necessarily the end of the AI trade. But what it could ultimately do is kind of open up the window for everybody else. And that's when I think I would really start to pay attention. I think there will be a huge amount of demand to own OpenAI for the long term. You'll have a lot of investors interested in doing that. But I think you'll also see, because of that demand, other companies will test the IPO waters, and likely we'll see a lot of other companies go public that aren't quite the quality of OpenAI. And that's when I think you can start to maybe really sound this bubble alarm that we're hearing right now in a more honest way.
I think you said in your notes to us that OpenAI is too big to fail. Is that how is that sort of a deliberate strategy on its part?
I don't know if it was deliberate at the outset, but it sort of seems that that's where they've been going. I mean, if you look at the partnerships that they have created now with Broadcom, Nvidia, AMD, it just feels like Oracle. I mean, everybody in the industry now is tied to OpenAI. They all have a vested interest in some way for that company to succeed. And so the way I think about this too big to fail concept is we get these questions about how can OpenAI continue to finance all these huge projects they're talking about. Well, the way they can continue to finance it is through all these partnerships that they've made and all these companies that have this really vested interest in supporting them and making the company successful. And so I think it's probably become part of the strategy is, look, if we can get tied to everybody and make sure that everybody sort of needs us to succeed in some sense to keep the stock rally going, it almost could become a self-fulfilling prophecy. And I think Sam Altman is sort of smart enough to realize that.
And Doug, finally, going into these more of these big cap tech earnings, I know you guys don't own Amazon. Why not?
Yeah, it's been one that the models that we use at Intelligent Alpha, they haven't really liked it all year. And that has been the right call because Amazon has been the worst performer of the Mag 7 year to date. I think there's two things. One is just as a human observer from the outside, this recent layoff announcement, the timing of it just feels a little bit suspect. From a political sort of 101 standpoint, if you were going to have great earnings, you probably don't want to announce earnings or announce layoffs 2 days ahead of those great earnings. You'd probably want to wait a little bit. And so that it's a yellow flag, right? I might be looking too much into that, but it's just something that just doesn't sit well with me. The other thing, though, is AWS. And if you look at the growth in AWS, it was 17.5% in Q2. The street's looking for an acceleration now in Q3. And I think that Google and Microsoft have done an incredible job competing in the cloud space, really leading on AI, where Amazon, I would argue, is in third place, even though they're the biggest cloud provider. I think they're probably third place in terms of AI in the cloud. And I'm concerned that they might not quite meet that bar. And I think our models feel the same way, and that's why we haven't owned the stock.
Doug, it's always good when the computers agree with you, I guess. Thank you so much for being here. It's good to see you.
Thanks, Julie.
Coming up is, we mentioned big tech earnings on deck. Which company's best positioned heading into the reports? That's next on Market Catalysts. Well, the top 10 stocks in the S&P 500 are surging back to dot-com era levels of dominance. A new chart from RBC Capital Markets shows the group equal weighted performance versus the rest of the S&P is approaching the highs of the early 2000s. This comes ahead of earnings from several of those big tech names. And joining me now, Jessica Inskip, stockbrokers.com Director of Investor Research. And before we even get to that, we got to talk about this OpenAI Microsoft news, I think, Jessica, because this, as I said, this is the crux. This is the center of this whole AI economy. Yes, there are other big companies like Anthropic that do this, but OpenAI obviously is the one making most of these deals.
Yeah, absolutely. And even the conversation with PayPal integrated into OpenAI, I thought that was very big today. And what really caught my attention is you said the race to artificial general intelligence. And it's something that I think all of these players is friendly type of competition, and the circular capital is a testament to that. Essentially, it's game theory. You want to be in the game. No one knows what artificial general intelligence actually is because this is all compounding and the technology is extremely iterative. And I think it's an important component to pay attention to is making sure everyone plays nice, and open source coding is actually winning because of that nature of this game, if you will. But it's going to be interesting to see how that plays out specifically. But artificial general intelligence is so far away, but it's fascinating to read the blogs about it.
Well, and not to go too far down the rabbit hole, but when you talk about open source, I mean, if you look at independent ratings of open source models, a lot of the top ones are in China. They're not here at all. And they're cheaper at that.
Yeah.
But that's a whole other.
But that's what
maybe,
Jensen Huang is saying. We need to, at least the Chinese, to access US tech stack. That's very important because you have some of the best coders and developers there, and open source is extremely important to bring heads together to make something amazing. So you have a very good point.
So Microsoft, everybody has a partnership with OpenAI.
That's true.
To your point, PayPal is making one this morning. But obviously the OpenAI-Microsoft relationship is unique.
It is.
And it is now sort of solidified and codified with this news today of Microsoft's now $135 billion stake in the OpenAI entity. Does that mean Microsoft's in a better spot than some of its competitors?
I wouldn't say it's in a better spot than its competitors, but I will say from an investing standpoint, now we can have more exposure. We at least have solidified that exposure to OpenAI, and that's important. Otherwise, it's not a public company, so we can't access it. I do think it still just heats up the competition. AI is so large, there is enough for everyone to have a piece of the pie. So not everyone's swimming in the same lane. I do think there's other opportunities for Oracle, example, what they come out with. I think what's interesting is brokerage firms who have APIs and then these MCPs, which are protocols that you can connect into these AI models. That, I think, is the next leg that we're going to see if we look at solely AI, because essentially it's an interface where you can I just need the best data from a source of some sort, and then I can pull that into a Claude model, or I really want to see what Oracle does, that's why it's my top pick there, to create your own interface utilizing data, but it requires the correct connectors. And I think that's just interesting for the reason that it circumvents when you are in a high regulatory environment like a brokerage firm, you have to have very specific data sets that are regulatory. So you can't easily implement an open AI model without going through compliance steps. However, you can create a bridge if you are a client or a customer where you're initiating that through something like Claude or Oracle or these models with a data set connector, then no longer you have that fiduciary responsibility for what's there. So that's, I think, streamlined because of the access that it provides. That's different.
Interesting. Okay, so you and it sounds like you think the investing case is not necessarily on the customers in financial services who will be using these kind of models, but on the infrastructure, continues to be with the infrastructure providers.
I agree, absolutely. Infrastructure, that's important. And there's so many opportunities. And what I do think is interesting, this week we've got all of the earnings coming out, and I briefly looked at positioning on the way over here, and positioning looking in the options market, because that's going to tell me if we're super optimistic. And I think it's going to be an interesting earnings take, because we're going to compare and contrast, because they're all on the same day, and that's not something we would normally do. But options positioning is exceedingly higher than normal, but what stood out to me was Amazon. All of them were about 1.8 to 1, so meaning there's, for every put, there's a 1.8 calls, so almost 2 times more, but for Amazon, it was 2.8. So there is very high expectations for Amazon, which means if the market does not like what's said, there could be more of a sell-off.
Interesting. Okay, so even though the expectations are higher, that sets them up to potentially do worse.
Absolutely.
In the wake of the numbers. Which do you think is best positioned going into earnings?
I believe Microsoft and Google are okay. Amazon concerns me because of those high numbers, but it's really how the market reacts to it I think is going to be important. And more importantly, the comparison. And then prior, of course, what the Fed says.
Yeah.
Because we have this market at all-time highs. It's sitting on 3 pillars, which is economic growth. We're seeing that, at least with the numbers and data that we can extrapolate thus far. That is earnings growth, which we're absolutely seeing, and into an easing Fed. Anything, it's like a stool, anything that breaks one of those, I feel like could be a collapse, and that's so important. So it feeds into what the Fed says tomorrow. That's going to be important with the Q&A, as you know, and the presser is extremely important, moves markets. Then that will lead into markets move on earnings. Let's hope those earning expectations aren't too high, but tomorrow is just going to be a big day. But surprisingly, a low vol environment.
Interesting.
Very low volatility.
Well, we'll see how all that works out. Thank you so much, Jessica.
Absolutely.
Appreciate it. Morgan Stanley has agreed to buy EquityZen. It's a trading platform that allows users to buy shares of private companies. And it comes as investors become more interested in owning pieces of highly valued startups. Joining me now, EquityZen CEO Atish Davda. Atish, it's great to see you. And I have to say, we've been talking for a few years now, so congrats on this deal. And we tend to talk to you about the IPO market and what's exciting on the private side of the business. And obviously, Morgan Stanley thinks there's a lot exciting on that side of the business. So just talk me through how this deal came to be and what you hope to get out of being part of that bigger entity.
Totally. And it's so good to be here again. You're totally right, Julie. We usually talk about IPOs. The challenge is companies are staying private longer and longer. So you have fewer IPOs. The number of publicly listed companies continues to be at an all-time low. And so if you're an investor that's only investing in public stocks, you're missing out on where a lot more value creation could be occurring, which is just, in other slices of the, of the portfolio. And so where EquityZen and Morgan Stanley came together is really several years ago. For the last couple of years, we've been trying to figure out a way to work together. Now, look, Morgan Stanley is a world-class organization, but it's a real pioneer in the private market space. They, acquired Solium ShareWorks, and they have the Morgan Stanley at Work program. And by doing that, they've been servicing private companies for a very long time. The piece that's been missing is the piece that connects all of that supply to the demand side, which requires technology, and it requires an issuer-friendly platform, which is essentially synonymous with the way EquityZen has tried to do business over the last 12 years.
And so as part of this deal, will that mean that Morgan Stanley customers have access to these private companies via EquityZen? Does that also mean that people outside of the Morgan Stanley ecosystem will not?
Actually, what we want to try and do is have EquityZen and Morgan Stanley really, join together. Morgan Stanley has this fantastic vision of an integrated firm. And I'll tell you just, really quickly why that was really appealing for EquityZen when we were trying to figure out, well, what is the right way for us to expand our distribution at a global level? Morgan Stanley has an investment bank. It has capital market syndication desks. It also, of course, has asset management arms and wealth management arm. And I think when you kind of take the whole firm together, what a private market solution can provide and what EquityZen specifically can bring to the table is connectivity to the self-directed user that Morgan Stanley has with E*TRADE, to the issuer client that Morgan Stanley has with Morgan Stanley at Work and with its Solium ShareWorks platform and the equity plan services, and also with the liquidity provision that Morgan Stanley already offers as part of their tender offer business. And so you kind of have the demand that Morgan Stanley already has at a world-class level. You have the supply and the issuer relationships that Morgan Stanley has at a world-class level. And the gap that EquityZen is really bridging for them together is the ability to connect the supply with the demand in a way that the issuers are actually really thrilled about.
Atish, I have a bigger picture question for you, which is with this increase in accessibility for investment in private companies that, it seems like people are clamoring for. Of course, there are differences between private and public companies, and one of the most important is that you don't have the transparency in those private companies as investments. Is there a way to solve for that? Do you think there will be some level of increased transparency going forward as these investments increase?
Look, as companies start getting bigger and bigger while still staying private, OpenAI is a great example of this. You currently have a large private company that has recently had a lot of equity research get initiated on it. So I think, I think the question used to be, will there be regulation that forces issuers to disclose more even while they're private companies? And I think what we're seeing is the market is answering that question. Companies want to educate the market more. Companies want to educate its client base more. And by virtue of doing that, you have conversations like the equity market coverage that is beginning to initiate on private companies. And I think that's going to keep going. But the important thing, however, is that the companies need to have control over it. I mean, EquityZen's platform has been built on the premise that the issuer has to have a seat at the table. It's an issuer-approved platform. It's actually why Morgan Stanley and EquityZen, we think, made such a fantastic match, because the issuer really is at the center of the entire ecosystem.
And just really quickly, Atish, do you think that there will be fewer companies going public still as a result of all of this?
I think that more companies that are private will continue to stay private longer. I'm not saying IPOs won't come back, But I think if you compare the proportion of companies that are public versus private, I do think the private pool will continue to grow more. If you just take a look at the market cap of private companies, you're talking about it being in the trillions now. That used to not really be the case, even as recently as 10 years ago. EquityZen's a 12-year-old platform, and we are very excited and fortunate to be able to take our know-how and learning and really catapult it onto the global scale and the institutional level that Morgan Stanley operates on.
Atish, thank you so much for your time today. Congrats again. Good to see you.
Good to see you.
Thanks. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance coming up.